Alright everyone, welcome back to what has been a one-sided final of the 47th National Inter-School Rapid Fire Quiz Competition. But theek hai, hota hai, and question number 15 to the contestants is, if I deposit 6 lakh rupees in a 9% bearing fixed deposit, in how many years will my money grow to 1 crore rupees? Yes, contestant A, that's fast.
It's 32 years.
That's correct. Just 1.3 seconds to give that answer. That's a new national record. Wow. Well done, contestant A. Arey ruko, hello, abhi show chalu hai. Listen, wait, where are you going? So what contestant A did was to take advantage of some thumb rules, and in this video I shall take you through 10 of those. Now thumb rules are nothing but guiding principles, which may not be 100% accurate, but they are sufficiently error-free, and more importantly they are based on real-life situations rather than theories. So there are dozens of thumb rules, and while I'll be prioritizing my top 10, but if you come across any additional ones, then do add them to the comments box below. And of course, don't forget to give this video a thumbs up. Let's begin. The rule of 72 helps us estimate by when our money will double. For example, if you invest in a fixed deposit that offers an yearly interest of 6%, then 72 divided by 6, which means it will take 12 years for you to double your money. Similarly, if the FD was giving 8%, then 72 by 8 is 9, so 9 years. And an investment offering 12% per annum will take 6 years to double your money. I think this is the same thumb rule that contestant A used to answer that rapid fire question. So he divided 1 crore by 6 lakhs, which came to roughly 16, and at 9% 1 becomes 2 in 8 years as per the rule of 72. So 1 becomes 2 in 8 years, 1 becomes 4 in 16 years. It is 8 in 24 years, and 1 turns to 16 in 32 years, and therefore the answer 32 years. Now, as I said before, this answer might not be 100% accurate. In fact, the correct answer is 32 years, 7 months and 28 days, but it is still pretty close for anyone to take a fast decision and keep moving forward. One can also reverse this rule to figure out the percentage of returns that one needs to double his or her money. For example, say you want to double your money in 4 years. So we have 72 in the numerator, we divide it by 4, which gives us an answer of 18, which means you need to come up with a financial instrument that can give you a return of 18% over the next 4 years for you to be able to double your money. And that's the rule of 72. A lot like the rule of 72, we have the rule of 114. And the objective of this rule is to give us an estimate of the time it will take for the money to triple. For example, a standard FD offers an interest rate of 8%. So 114 divided by 8 comes to 14.25, which means a rupee invested in an 8% fixed deposit becomes 3 rupees in a little over 14 years. You can try this in your calculators as well, and the numbers will be very close. In fact, you can use this thumb rule matically on equities, which are expected to give 12% over the long run. So 114 divided by 12 comes to almost 10, which means 1 rupee becomes 3 in 10 years. So remember this, 1 becomes 3 in 10 years when you invest in equities, which means 3 becomes 9 in another 10 years, 9 is 27 in another 10, and overall 1 becomes 81 in about 40 years. Which is another way of saying that if you gift 12 lakhs to your child or grandchild on his or her 20th birthday, and if this money is invested in an instrument that makes 12% over the next 40 years, which hopefully equities can give, then that's like giving your child or grandchild a 10 crore retirement gift. Of course, this is a crude example and there is inflation and other stuff to worry about, but I'm sure you get the point. And speaking of inflation, there is the rule of 70 that estimates the impact of inflation on one's wealth. For example, say you have accumulated a crore of rupees until today, and for some reason you have stashed it away in your gharwala locker. Now, since the long-term inflation of our country is 5%, we do 70 divided by 5, which gives us 14. So 14 years is around when that 1 crore of rupee that you've left in that locker will be worth half, that is 50 lakhs, assuming you don't do anything with it. It's a very handy thumb rule that helps us understand the time value of money. So when you get the opportunity, do try and use it. The next rule is 12-6-3. And while it sounds like one of those complete the series games we used to play when we were young, these 3 numbers merely represent the expected rate of return from 3 essential asset classes. So what the 12-6-3 rule says is that when taking long-term investing decisions, Then assume a 12% annual return from equities, a 6% yearly return from debt instruments like bonds, and a 3% return from your savings bank account. Of course, these numbers are not guaranteed, but that's the thing about thumb rules. It's there to present us with a simple, less than accurate, but effective method which guarantees faster calculations and quick decision making. And speaking of equities and especially SIPs, the most frequently used Crorepati thumb rule is the 15-15-15. So all it says is you invest 15,000 rupees a month, you invest it for a period of 15 years, and you do it in a stock or mutual fund that's capable of delivering 15% on an annualized basis. Again, this last 15, the 15% is a big assumption, but assuming this can be done, this simple investing plan would have helped an investor accumulate a little over 1 crore at the end of 15 years. So technically this isn't a thumb rule, but more of a mathematical way of wealth creation. But as a concept, this 15-15-15 can be tweaked in many ways. For example, if achieving 15% return seems to be a little high, then you can look at 20-12-15, that is 20,000 rupees per month at 12% per annum and for 15 years, which also gives us a corpus of 1 crore. Again, if 20,000 seems a bit high, then one can try the 10-12-20, which also gives us 1 crore. In fact, another variation of the 15-15-15 is the 15-15-30, which simply says you put in 15,000 rupees every month at 15% returns for 30 years and your money would have grown to 10 crore rupees. So try these variations out in SIP calculators which are available in most finance and investing websites, and keep a couple of these combinations in your head for easy reference. So one number I often use, which I call it my golden number, is 12.2%. Well, simply said, 1 rupee when compounded at 12.2% becomes 10 rupees in 20 years. So that's the rule, and you can try it out in Microsoft Excel or any calculator. Now, because I know this simple formula and 12.2% is exactly what I assume is going to be India's long-term rate of return on equities, it allows me to use this rule in very creative and largely effective ways. For instance, one of the reasons I was able to quit my job and try out YouTube as a full-time activity was because of this 12.2% rule. I mean, I didn't even have to whip out a calculator. I knew how much money I had accumulated so far, and let's say that number is a crore. Which means if I put this money in a diversified equity fund for the next 20 years, then that would have fetched me a total of 10 crores, which would be a good starting base for my retirement years. As a second example, let's work on a scenario that many of us face. That is, we have no idea how much retirement money we need to accumulate during our working lives. Meaning, do we need 2 crores or 5 crores or 10 or even 20 crores in our retirement years? And I've generally found online calculators to be a bit complicated in this respect. So I'll take myself, a 43-year-old's case here, and let's assume I don't have any savings, which means I am financially at square zero. So in a case like this, I can use the same 1 to 10 rule that I just presented, but instead of thinking that I need to build a big corpus, let's think of it on a monthly expense basis. Let's say when I turn 63, that is 20 years from now, my monthly expense will be 2 lakh rupees a month. I mean, thankfully, ghar apna hai. So I think 2 lakhs should be pretty good, which means if I put 20,000 rupees this month in a 12.2% fund, then there is a decent likelihood that it will become 2 lakh rupees exactly 20 years from now. And this sequencing is something I can do every month and for every year. So next year when I'm 44 years old, instead of 20,000 rupees, maybe I can invest 21,000 rupees every month for that year, so that inflation is also accounted for. Effectively, what I invest in my 43rd, 44th, 45th year will bear fruit in terms of a 10x return in my 63rd, 64th, 65th year, and I can use that money for my that month's expense. It's a very different way of looking at the same problem, but instead of getting bogged down by trying to estimate how many crores I need, I was able to recalibrate the problem and think in terms of how much I need in that month in the future to live by. And all this was possible because of the golden 12.2% rule, which converts a rupee into 10 rupees over a 20-year period. So give it a shot and let me know in the comments box if it clears up your mind. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. The 100 minus age thumb rule is a rather popular one and something DIY or Gharelu financial advisors often refer to. This rule pertains to asset allocation, that is, how much of your wealth should be in riskier assets like equities and how much should go into safer fixed income instruments. This is done by subtracting your age from 100 and the resulting number is the percentage of your wealth that should be invested in equities. So in my case, 57% of my investable wealth should be in equities and the remaining 43% should be in debt instruments, at least that's what the rule says. In my opinion, this rule is certainly well intentioned, and if you haven't been paying attention to asset allocation, then I think the 100 minus age rule is a simple and a very good place to start. But like any thumb rule, it does have some shortcomings. For instance, the rule does not take into account the different types of goals that you might have. Like in my case, my retirement goal, which is 20 years away, will need a different asset allocation mix as compared to my start a business goal, which is only 3 years away. In the same thread, this thumbnail ignores other variables like a person's income, his existing assets, inheritance amount, liabilities, etc., and buckets everyone of the same age within the same risk bucket, which is not very practical. The point is, investors need to do some additional work on top of this 100 minus age rule, and to help out, I'll certainly make a video on asset allocation in the coming few weeks. The next thumb rule in my list is something I have created for myself. So this is not a universally accepted thumb rule, which means you can either use it or ignore it, or better still, you can modify it to suit your own requirements. Now, I do a fairly decent amount of research when identifying stocks for my own portfolio. I look at the company, the industry, the financials, the competitors, the moats, the growth runways, and of course the valuation before buying any stock. But in spite of all this effort, one, maybe 1.5 stocks out of 10 doesn't do well, and some of them fall by as high as 30% from the price I paid for that stock. Of course, there was a time when I used to think of a price drop as an opportunity to buy more of the stock, but over time my views and approach towards investing have evolved. Which means any time a stock that I had carefully researched goes below the 30% mark, I simply take a deep breath and I sell off the remaining quantities of that stock with the tacit assumption that probably I made a mistake somewhere in my calculation. You see, what I have realized is that good investing is not about being stubborn. In that context, my 30% stop loss rule is my way of saying sorry and recouping the remaining 70%, which is still quite a bit, and then applying that 70% into a better opportunity. So it's about learning from one's mistake, and the 30% stop loss rule keeps me a lot more grounded in that regards. The 1 week spending rule is a highly recommended one, which says if something shiny, something new were to catch your eye and you feel like buying it, then wait for an entire week before actually buying it. I used to think this rule is more applicable when I'm in the supermarket, but with websites like Amazon continuously nudging customers to buy more, I guess one has to be always careful. So as a rule, give yourself that hibernation period of 1 week, and at the end of that week, always ask yourself these questions. 1. How useful will this purchase be for me? Number 2, how was I living without that product? And thirdly, can this money be used elsewhere for something that is more important? If after answering these questions, you still feel strongly about the purchase, then only should you go for it. And finally, a personal finance portfolio is never complete without a life insurance policy. The thumb rule here is that your life cover should be at least 20 times your current annual income. But if you have already built up some wealth or have some inheritance at play, then you can modify this formula to suit your needs. Now, some insurance companies offer a 20x cover on your income, some allow 15, but if you're in your 20s and 30s, then do strive for the highest possible cover, as this multiplier will ensure adequate financial protection to your family in case of your untimely demise. It's an exercise not worth ignoring, and the sooner you can get into an insurance contract, the cheaper it becomes. So these were 10 thumb rules that are commonly used in investing and the personal finance framework. And if used correctly, these can help you sort out your finances and define how you generally think about money. Personally, I've used many of these rules: the rule of 72, the 12.2% framework, the 20x life cover, 30% stop loss, the 1 week spending rule. So I've used most of them, and generally I've found all of them work in different situations. So study these rules carefully, try and remember a few by writing it down. Do give this video a thumbs up, and I'll see you next week. Until then.